So before I start unpacking all the data, I want to create some additional context that is meaning for us as investors on the impact of a number of the government housing policy changes that have been put in place. Ultimately, when we break things down, it adds up to what I'm going to put in a context of three things that are going to maybe make a difference that we have to pay attention to. Firstly, the changes that they've made are going to have an impact on big rental projects that will definitely start to move forward. Secondly, there's going to be more density, which is being added to the cities in general, certainly in our major cities, Vancouver, Toronto, Montreal, Calgary, for example. And thirdly, there's a handful of changes that are going to make a difference for first-time home buyers, but only a small difference. And we really have to pay attention to that because that is where our opportunity lives. So as investors, we have to review our overarching thesis for investing in real estate. We need to consider the data as always and look at what's unfolding in really what is a global macroeconomic world that breaks down into how that impacts Canada, how it impacts our provinces, certainly how it impacts our cities. And when we look at this smattering of new housing policies, part of the opportunity that is presenting itself is how does it help or who does it help? So when we break it all down, it's going to be dependent on what province we're talking about, the landlord and the tenant rules, and what is changing or going to shift. Because ultimately, we know that the goal is to have renters eventually benefit from these changes. We want to see, and the government wants to see people living in subsidized housing eventually benefit. And then ultimately, builders and contractors who are going to build more units on what are now single family lots in cities. And we see a lot of that in Vancouver, hearing a lot about it, Toronto, for example, Calgary, Montreal. This densification is a big issue. And then there's some benefits to people who can afford to save for down payments, that first-time home buyers, or who actually have parents who can gift their payments. And this is all based on just what's happened over the last few weeks. So we have to consider that about 85% of all of the money, which I think is about 40 billion, has been allocated by the feds. And it's all about rentals and building rental inventory, more housing, et cetera. And that's through programs through CMHC, for example. And that is ultimately their goal. Now, we can't, and we have to consider their ability to execute on that plan. And aside from that, we know that we just need new rental stock badly, which for us as real estate investors is helpful. But for young people who want to own their own homes, really not much has changed. So what does that mean to us? Because when we consider that even though there were improvements to down payment savings programs and minor changes to amortizations extending to 30 years and beyond, for example, there's little impact for first-time home buyers or even younger individuals who want to upgrade from small condos, for example, to bigger detached homes. Because to really help first-time home buyers, we need two things. First, we need a massive increase in new home building, which is not happening. We need lower home prices, or at least virtually no house price increases for the next few years. But in reality, we are just not building more homes. We're building fewer homes, and we're going to look at the data about that. So how do first-time home buyers even get in the game? Because as you're going to see by the data, there's actually fewer housing starts, not more. And so what does this all mean for us as investors? So when we look at the data, we see a lot of uncertainty economically. We see the headwinds facing the real estate market. And as we can see in the real estate market, there is a lot of bad news for retail buyers, for first-time home buyers, or even for next-time home buyers. So when we look at the underlying headlines or read between the headlines, this is an opportunity which is based on the fundamental reality that people still need a place to live. And like it or not, Canada, for the most part, is becoming a renter nation. Affordability is, and I think it's going to continue to be an issue for the foreseeable future. So when we continue to look at the market as investors, it's easy to see the opportunity as rental housing providers. And that is actually the wave that we need to stay in front of. So yes, it is definitely harder work to find deals. And I'm hearing a lot of that feedback from the member community, as well as, investors outside the community, even big developers and builders. But as I've shared many times, there is not a bad time for investing in real estate. There's just simply the need to adjust our strategy. Now, we see the gap, which is the shortage of housing, the lack of affordability for first-time home buyers, and that is in fact what creates the opportunity. Right now, finding deals that make sense, that cash flow, or getting the financing for the deals you do find are all part of the headwinds that we face as investors. So, for many of us, it means we need to change the strategy. Now, in this scenario, knowing that the demand for rental housing is going to continue, if nothing else, it's going to escalate and it's going to continue to grow. And that means that placing capital in real estate as a store of value continues to make sense. That's the fundamental or an underlying thesis of investing in real estate. I would suggest that, in fact, it makes more sense now than ever. So, my suggestion for many investors is to look closer at the opportunities that exist with our trusted partners, for example, who have built successful REITs or limited partnerships or general partnerships. We look at trusted partners such as Equiton, Ferris Capital Partners, WealthShare, and that's just to name a few. So right now, if you're finding yourself sitting on the sidelines because you can't find deals, you can't get mortgages, you can't come up with a down payment, if you take that whole search for do-it-yourself cash flowing properties and mortgage qualifications off the table, you can actually look at getting into real estate with less capital investment. And you can actually, in fact, diversify your capital into more options. Now, I just want to finish by saying it's more important than ever to put our capital to work, because for anyone who is following along, whether you're looking at growing or getting past the inflation or debasement of our dollar, the bottom line is we need to put our capital to work. And we are, in fact, losing our buying power, and that is not changing or going away anytime soon. So if you find yourself, again, sitting on the sidelines because you can't find those deals, can't get that mortgage, can't come up with a 20 or 30% for a down payment, then this is the time to consider adjusting your strategy. I'll say it again, is that investing in real estate is still a great store of value. Building your portfolio is creating that financial future given the economic conditions that we face and as we look into the future. So part of that strategy, again, is making it easier, getting your capital into the REITs, into those LPs, into those GPs, and getting your capital to work. Okay, let's dig into some of the data that supports all of that. If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.